We already know the Fed lowered interest rates and they're going to continue, but the 30-year mortgage started to go up. It's because of how we get our 30-year mortgages. You see, in order to get the debt into the market, we have to sell bonds. Now, these are sold from the Treasury, and we have a 30-year Treasury. Now, if an investor buys a 30-year Treasury, they are going to get a 4.6% return. When everyone's worried, in order to get this debt, you have buyers and you have the government selling. Now, this is the key. Debt is a marketplace. And when everyone is really worried about the economy, they rush to find safe assets that will pay them a return. That way their money isn't worth less because of inflation. People run and they buy things like the 30-year Treasury. Now, when you have more demand, you actually have to pay them less. So rates go down because you have more buyers than you have Treasury bonds. So you don't have to pay as much because everybody wants them. It's the opposite though if everyone thinks that the economy is going to boom. So if you're an investor and you're going to buy a Treasury that pays you 4%, that's because you think that this is safe, and all the other assets like stocks, bonds, your real estate, all of that, everything else won't perform as well. So you're going to buy this because it's the safest, best option for this return. But if I think that the stock market's going to go up, and if I think that we're going to have rise and increase in inflation and businesses are going to grow and the economy is going to do good, I'm going to sell these and I'm going to buy other assets. Essentially, we have to pay investors more so they buy the asset. And this is what's happening. You see, right here, once we had a new administration, we saw a change in the flow of money, meaning people expected things like inflation and a pro-business environment, deregulation. So the money started to move into assets that would benefit from that, meaning we expect growth. That's what investors were saying. And they started to buy assets that would produce a good return in that environment. And they also thought that these won't do as good. So they left them. And that's why we had interest rates start to rise. Because it is affected by supply and demand, it is a normal marketplace. Now, normally we see this in the short term as money adjusts. And then over time, as the Fed keeps lowering interest rates, we generally will see these follow. The Treasury yields will be represented as people are buying and selling, but they are not a direct reflection of the Fed and lowering interest rates, because this happens in a marketplace. But your 30-year mortgage can actually go up. So are they going to stay high? Are they going to go higher? Well, the truth is we don't really know. But generally speaking, this is most likely an after-election bump. We saw this with all sorts of assets. Remember, as yields went up, this means investors were not wanting to buy. But guess what they did want to buy? Stock market. And the stock market went up. In fact, it roared. This too is generally a reaction to the shift of mass money in the economy. Normally, like we've seen in the last few days, the stock market starts to cool off and it starts to come back down. Now, it did not go back down, but it still gave off some of those gains and cooled down a little. This is generally what we see and would expect to see, that this is probably a high in a trend. And as things adjust, we will see 30-year mortgages lower, especially because when we have change, we have uncertainty. So investors are celebrating a pro-business environment and buying up stocks and other assets. But they're always going to get scared about something. And there's a lot of change going on in the world, which means we will have events and things that happen that make investors want to flee back to safety. As this happens, we will find an equilibrium in the marketplace. But in the short term, it can seem to be a little volatile, especially when there is large political change and investors are digesting all of that information to try to understand where to put their money for the future.